Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day investing out there. As always, we are looking at another watch list stock, and this one's different. It's a REIT. For those of you who want that passive income, shame on you, okay? Shame on you. No, I'm kidding, but not kidding, but kidding, but also not. All right, so we're looking at MPW, or Medical Properties Trust. This is the next episode of the Watchlist series with the market being down. Now, REITs, you guys know my opinion on REITs, or have known my opinion on REITs for quite some time. If you're new to the show, just ask any of the subscribers who've been with me for a year now, or almost a year now, and they'll fill you in with the details. So basically, there's this whole thing that we've been talking about for quite some time. Just to summarize, liquidity crunch. I don't have any REITs in my portfolio anymore. I would love to own some REITs, maybe add some REITs back in. MPW actually's chart follows perfectly the liquidity crunch. It's one of the REITs that does. Some REITs don't. Some of the REITs have been a little bit slower to fall, but let's take a look at that 1 year. You can see about in January, whenever that video actually came out. I think it was actually towards the end of January, but around here, I talked extensively about the liquidity crunch and why I don't have any REITs, and or when I sold my REITs. And yeah, you can kind of see it basically downtrended since then. One thing I want to highlight is this is an interesting type of business. So if we actually take a look at the whiteboard, I'll try to talk about it. So with MPW, you're basically getting hospitals. They'll just label it as H. So hospital is H. You don't actually build a hospital next to an old hospital. So you don't really do this. There's actually restrictions on that. If I get into it, it's really mafioso in terms of how to build a new hospital. I could have $1 billion and I can't really get approval to build a new hospital. It really is kind of not free market in the United States, to say the least. But for the most part, it is a double-edged sword. So you'll hear me with these specialty REITs that they're pretty much double-edged swords. I talked about this when I talked about Vici, which we'll get its own video because that's also on the watch list. But we're looking at MPW here, and let's say your operator goes bust. All right, your operator goes bust. So now you're stuck with a hospital, and what can you turn this hospital into? What are your options? Can you turn it into a hotel? Probably not. Maybe. I don't know. It really just depends. My point is, once you're stuck with that land, that property that's retrofitted to be a hospital, that's pretty much what it is. So the optionality for that piece of property is pretty much the land, and that's about it. You got to demolish it, restart it, do something else. So it really does suck. But the benefit is longer term leases, okay, longer term lease agreements, because the tenant's like, okay, this is where I do my business. This is where I do my base of operations. I got to stay here for quite some time. So I'm probably going to sign that lease agreement for a very long time. That's a benefit. That's steady revenue stream for that REIT, predictable revenue stream, and they're probably going to sign in for some escalators. In real estate, when we talk about commercial real estate, we look at escalators as a pre-approved agreement between the tenant and the landlord, whether or not said rent will go up by a certain amount. And sometimes there's CPI escalators. So a CPI escalator is quite literally what it sounds like. It's basically like the rent increases alongside with the CPI. And then sometimes there'll be like a percent difference between it. So it'll be like 2% standard plus CPI. Right, for example. And sometimes they'll agree, depending on the power of the tenant, there'll be like a cap on it. So like 2% plus CPI up to 8%, for an example, right? So that all can be shown up in the agreement. We don't really know the exact details of each agreement. We don't get that kind of privy information, but we can only assume by what management tells us that they're pretty much, good on that. Now, I'm going to show you another real estate investment trust, which is one that is constantly cheap, another double-edged sword, which is OHI. OHI is yielding about 9.74%. So for those of you who are yield whores out there, yes, I called you that. Exactly. I'm not kidding. I am calling you that. This one looks catching, looks interesting. And then if you actually take a look at that 5-year performance, it's pretty much been dead money, down 19.40%. All the return has pretty much been from that dividend. And just so kind of before I forget to mention this, the only times I've owned real estate investment trusts or REITs has been through my retirement account. Okay. And again, I only hold it in my retirement account. I don't like to hold it in my non-retirement account for that tax benefits, but you got to actually discuss your personalized tax financial advisor, whatever, in your personal area, whatever country you're in, figure out what it is best for you. But I'm just giving you like disclosure. That's how I own them. Well, I don't own them right now, but I'm looking to own them again in the future. So it's a great way to get exposure to specific types of real estate. There's a lot of specialty REITs, and these specialty REITs, the thing is that they're hyper-focused in one particular aspect of real estate. MPW, OHI, they're focused on different things. And actually within their category, which is medical properties trust is actually focused on a lot of hospitals, which we'll actually take a look at on their website. So if I take you over to their website, you go here to the portfolio, pretty easy to go. And yes, we're going to look at the financial statements. I know, boring. Okay, so if it decides to, there we go. I was like, why are you not loading? Are you just trying to, ruin my reputation with my fans? Is that what you're trying to do? All right. So anyway, we have a general acute care hospital. So basically, it gives you the breakdown. You guys can read, and you scroll down here. They got visualizations. They got visuals. So not just numbers. They got visuals. So you can see how basically by the size, if you're a visual learner, this is good for you. United States breakdown, international breakdown. They can also break down by country, U.S. state. Pretty nice. A lot of information here. 440 facilities. They got a little map with little arrows. You can like pinpoint where things are. You see Australia filled up. You see Europe filled up. You see United States filled up. And okay, that's Colombia. I was like, oh my God, is that Venezuela? No, it's Colombia. Whew. Okay. By the way, I'm Venezuelan for any new viewers. But oh, and they got some in Spain. Oh, great. And is that Portugal? That might be some in Portugal. So anyways, pretty much across the board, global company, getting that rental revenue, getting that bread in multiple different types of currency. So yes, I use that word. I know you got to make some jokes here because it is not a real estate. We're talking about stocks here, so you gotta make some jokes. Okay, you gotta keep the mood up. All right, so let's go over to the financials and then the presentation, or no, let's go presentation then financials. All right, so if we go to the presentation, let's be honest, this is the sales pitch. This is going to be their best foot forward. They're going to be like, look at us, we're amazing. I expect a pat on the back slide. I haven't checked out the slide yet. I like to do this with you guys. Again, it's part of the fun doing it with you guys. So let's go down and see through this. Okay, so premium real estate returns. Don't know what that means. I guess they'll explain that to us. Backed by long-term. Okay. Okay, this is why I'm going to highlight the wording, long-term net leases. Net lease basically means that some, if not all, of the costs of the property are passed on to the tenant. So there's net lease, double net lease, triple net lease, and those basically vary in terms of liability over to the tenant versus the landlord. Triple net lease is typically the most, not the most pristine, but it is the one where the least amount of liability is put onto the landlord, and most of it's put onto the tenant. Maintenance of the property, property tax, all of that jazz. Any fixes that need to be done, all of that. Okay, so that being said, let's actually move over to the next chart. And here we have a chart of the dividends. So we see the dividends, and it is reflective of dilution. Okay, reflects dilution of September 2018 sale of 50% of median lease facilities. Okay, so all well and good. And a lot of that return, you can see 356% of that return, a lot of that's been from the dividend. Because if I take you back over here to the price and we look at that max chart from about, I think it was 2012. Let's just take that and let's go here. So they're only up about 58.49% in terms of price, but a lot of that return actually came from the dividend. You compound the dividend, et cetera. Remember that a REIT is a pass-through entity, so that they don't pay the taxes you do. For all you accountants out there, you know exactly what that means when I say the word pass-through entity. Pass-through entity. All right. So taking a look down here, they see, okay, so they're trying to say, look at our multiple. We're so cheap. Look at Welltower. Don't do that. Don't do that. Right? That's a little bit misleading because it's the property types that you have. Physicians Realty Trust DOC should be trading at a higher multiple because they have a lot more versatile portfolio. They own a lot of medical offices. So like your doctor's office, your general practitioner, that kind of stuff. VTR owns a lot of, it's a lot bigger, first of all, so it has access to greater amounts of capital. But also the property types are a little bit different, a lot more diversified portfolio. They also own a lot of medical facilities, medical offices, stuff like that. And actually, let's take a look at VTR in terms of price action because I just mentioned them. So VTR, and I'll show you like the difference in size. So this one's about a 19 billion versus the MPW about 8.8 billion. This company is probably, if I had to guess, yep, look at that. So it's also down too. But you can see this one. This one's one of the ones that was weird. And this is the one I told you I discussed with an old professor of mine who we were talking about this. And she said, well, what you weren't kind of considering is the fact that a lot of these larger ones, the market might give them a premium for a moment in time, that, there's a lot of competition that's leaving the market in form of these bids for these properties. So they're able to expand a little bit faster. So Ventas is one that was actually thrown away during the pandemic. If I actually show you that right here, you could have picked this up cheap as heck. And I remember for a while, I think even I know this is like kind of weird to say or embarrassing to say, but like the CEO went on Jim Cramer's show or something, and she was trying to pitch her company. But it was one of the ones that actually was pretty cheap and pretty good. So you can't throw everything away just because someone talks to them. But regardless, a lot of over the 5-year returns has been through the dividends as well. So not pretty subpar performance. So when I see that the company's saying, look at their multiple, look at our multiple, what's going on, I'd be like, don't do that, right? Like, I get it, you're cheap, don't do that, all right? So taking a look at that dividend yield, they have the second highest dividend yield of these comparison, OHI being the highest. We just went over OHI. There's a lot of risk associated with OHI. You got to be careful with tenant exposure. Tenant exposure is so important for these companies. Remember, because of that discussion we had in the whiteboard regarding the tenant, the double-edged sword scenario, remember, it's good in some cases, bad in other cases. there you go. You gotta take the good with the bad, and there is some bad there too. So kind of going through here, rents are paid. Okay, so basically all that jazz. Okay, they're basically like saying we're great, we're doing all this stuff. Our underwriting's great, our structure's great, our contingencies are great. Okay, cool, right? Just take their word for it, I guess. Cash rent yields go rapidly with inflation. There you go. So they're basically talking about that. You see, I told you about CPI-based escalators beginning in 2022. Well, I didn't say it was beginning in 2022, but I said that don't be surprised that they have them. They do have them. And let's take a look at their yield on cost. Yield on cost is higher for obviously the older properties because the rents have been able to escalate. The newer properties are coming in at about what is that, like eyeballing at 6.5% and above. So that's basically what their properties get. Every type of commercial property will have different cap rates, and so cap rates over time might stay the same. So, but the yield on cost, which is the yield or the rental or the NOI, because I actually did this. Remember when the old REIT video, I simplified it, and I'll show this again. I simplified technically the cap rate is just rent over price, but because in the one that got with the audio glitch was unfortunate, I did go on a tirade to explain why it's technically not rent, but I was oversimplifying it for the example. That's technically NOI. And then if you're in a commercial real estate business, you were probably like screaming at me. I think one of you did comment on that, and I apologize for it. I was like, yeah, in the original video, I did mention it, but for the simplification for the wider audience, just think rent divided by price is your cap rate. Okay. But no, that's not true. It's technically NOI. So anyways, going back through here, and like we'll do that sometimes. Like I told you, like we'll sometimes do underwriting for maybe different offerings we're trying to make on a commercial property. We did acquire in our area where I work now a bunch of warehouses. So we were there in industrial. So like we were not competing directly because we're not in that business. We're not a REIT, but like Prologis acquires a lot of those properties. And with the warehouse space kind of heating up a lot, the cap rates got pretty ridiculous. And in the Florida area, there's an area called the Field of Dreams or Valley of Dreams or whatever. And it's because of the location. It's so primal, not primal, but it's prime location because it's near the highways. It's in between two major cities, and it has a port in Tampa. So it's a good place to be. Anyways, kind of over here, MPT reporting. So basically they're saying, look at us, we're great on this. Okay, cash flow, property support, growing. Okay, obviously you're going to say that Reward Hospital has been highly successful. Okay, you're going to say highly successful. But okay, so this is, I think they're going to start to highlight the little investments they made. Because, okay, so here's the part where a lot of REITs are pursuing this strategy. If you guys pay attention to Brookfield Asset Management and Simon Property Group, they did this with Forever 21, I believe, and where they basically start investing into their tenants themselves. So you'll see that they do this, and this is MPT Equity Investments. So I want to actually say consolidated real estate investments, unconsolidated real estate investments, and other assets. We'll take a look here. So here they're breaking it down. And again, they're breaking it down the same pie chart. It should be the same pie chart. Yeah, it's the same pie chart here. So it still breaks it down. Here you have the form of debt. So if it's NA, obviously this is debt, not equity, because it's not an ownership interest. So therefore, yeah. And then so they have international joint venture at 49% equity ownership. So they have a passive stake, technically speaking, or maybe they're active. I don't know. Okay, no, they say passive. So this one is not passive. The 449, all the 49s are not passive. The 10%, the 9% are all passive. I prefer them to be passive. I'd rather have management kind of focus. But if they have such a large equity stake, I'll accept that they're being active on that business. Well, they also deserve to because they own so much of it. But regardless, this is like kind of like a call option you could say on the business overall. Support executives. Okay, so cool. Okay, this is definitely the pat on the back slide. So they donate. Okay, cool. You guys donate. Good. Oh, well and good. All right, from there, let's actually head over to the financials, and we're going to explore this company's balance sheet. So, okay, so little joke to make you accountants cringe. Let's depreciate the land. No, I'm kidding. You can't do that. But yeah, if you guys remember my older video, you guys cannot depreciate this line item, buildings and improvements. Construction in progress. So this is interesting because for this company, they have a lot of construction projects. In other REITs, we didn't see stuff like this because they buy it after the fact, after it's already built, or they buy it from it. So a rent leaseback agreement or purchase leaseback agreement. And these don't really seem to be doing that, except they did do that with one of their operators. I think it's HCI, ticker symbol HCI. But anyways, regardless. And then they have intangible lease assets, so the valuation of their intangibles there, investment in financing leases, okay, mortgage loans. Okay, so they own some mortgage loans here. And real estate held for sale. They have about $1 billion in there. Okay, so looking over at debt, they have the liabilities right here. They don't have any short-term liabilities. No, they do. They do. Accounts payable, deferred revenue, net debt. Okay, so they just have it organized interestingly here. Total liabilities. All right, so cool. All well and good. If you remember the other REITs that we talked about, this allocation or this asset to liabilities allocation is a bit less conservative than some of the other ones. Now, going over here, they have the income statement, rent, straight line rent, income from financing, lease income. Remember, they have some mortgages too. Total revenue is $1.5 billion. Nice growth there. Expenses, they have the interest expense from their loans. Real estate depreciation, that's not a cash expense, but it is a deterioration measure. Property related, general administrative. Okay, part of the business. Cool. All right, so all well and good there. Let's go to the statement of cash flows here. So statement of cash flows, no operating activities, $811 million. They're not going to really have any stuff like that. Dividends paid, cash flows. It's pretty sustainable, but it's teetering on the edge. And if you look at the net income, on a net income basis, funnily enough, because usually it's not, and then people go, that's bad. It's like, no, it's not, because it's cash flows. It's a REIT. It's not a C Corp. It's a REIT. Don't do that. All right, so with that being said, we're going to head over to the valuation part of the video, and we are going to basically finish off with our final thoughts. All right, we're back here with the 3M, and we're going to do MPW. We're going to let it load. I'll move you here to the side because we want to see what the analysts say. And I want to actually correct something because I know that I got this question in the live stream today. Like, oh, do you hate analysts? You think they're stupid? No, I don't think they're stupid. So if I come across as that, I apologize. I don't think they're stupid. Far from it. I think they're very intelligent. That's why analysts even exist. All right, so just a reminder for everyone, we are looking at a REIT. So we're going to say to the model, hey, yeah, we're looking at a REIT. Oh, where's it focused on? All right, I was like typing somewhere else. All right, so we're saying REIT, please, and we are also going to indicate to it. Yeah, that's basically it. We don't really need to tell it anything else. Okay, so taking a look here, I want to highlight to you guys that the growth rate of the FFO or the cash flows has been 75.73%. Please remember that is because they issue some shares and they acquire a bunch of real estate. So that growth is going to be tampered. So if you just take into account that growth without actually allocating or taking into account this thing down here, you see this? This is the shares outstanding, right? This is the shares outstanding here. Bleh. And this is the cash flows. Bleh. This is the rent. Bleh. And then I also wanted to go over what the analysts say. The analysts have a buy rating with a 23.29% price target, implying a 58.87% upside. Therefore, you should just buy it because they said that. I'm kidding. That's why people probably got that sentiment. So you see the Altman Z-score is telling you unknown, but the model zone metric is also telling you unknown. So, Altman Z-score is mainly for like those industrial plays, but still we look at it. Let's see here. PE, ignore PE. Don't worry about that. It's a REIT for Pete's sake. So don't look at that. Okay. So what am I looking at here? I am looking at probably something that is pretty freaking cheap. Okay. Only one thing. Let's actually reduce this guy to about, let's just say they continue to do the same amount, dilution. All right, so if they continue to do the same amount of dilution, you can kind of see that dilution has to be matched with some growth, some rental growth, okay? So I want to also say that, well, actually, I know I told you guys that this stuff would be stuff. These are old metrics that when I updated the back end of the model, it stopped calculating because I changed some things. And then so I have to readjust these because, some of these are my own metrics and you guys have never seen those. And I'm not sharing the formulas, by the way. So, but there's stuff I use, for example, to look at some companies and it changes depending if I'm looking at a C Corp or not. But anyways, looking at this guy, we would actually assume, I don't think they're going to be able to find the same level of deals consistently over and over and over again. So again, this cash flow growth necessarily over time. Like for example, this is probably the sale of an asset right here that occurred in 2018 because there's no reason for the cash flows to jump up like that and then drop all of a sudden. And then cash flows, I don't know if they're estimated to sell another property here. So I'm going to actually reduce this growth because I don't think that's 75%. It's taken into account this anomaly right here, this growth. So that's why we look at the visualizations as well to kind of match that. All right, so That being said, I think that, for example, a 30-ish% is possible. That's probably on the lower end, so I'll actually move that down. Not lower end, but not the highest end, I mean. So 30%, and that's, again, assuming that level of dilution. And on the lowest, let's say 35, I'd say. But again, remember, that 75 is misleading because that cash flow jump right there. All right, so, and if they are able to grow that, remember that dilution rate is actually reducing that in terms of a per share basis. On a per share basis, it's actually not increasing by that much, okay? Just so everyone understands, because I have to explain that every time, because people are going to see that growth there, and then they see the rental growth, and they're going to be like, you know, that's impossible. Like, remember, you're getting that. It's all about the per share basis, because that the REITs dilute a lot, and it makes sense, because if you're, let me go back to the whiteboard. And then anyone in commercial real estate can back this up, because, you know, it's pretty basic stuff. So let's kind of oversimplify the scenario. So let's say you have MPW shares, and MPW, when it traded cheaper, let's say it was trading at, this is why it actually makes it harder for them when the share prices actually go down. But let's say MPW is trading at a dividend yield of, I don't know, 3%. All right, 3%. So that means that they find a hospital, they find a RE, and they find it yields 6%. So they can issue shares to acquire this property, and they technically have a delta of about 3%. That's an accretion value that adds to the FFO of the per share. Okay, so it's actually accretive to the shareholders. Now, let's actually change up the scenario. All right. And let's say, well, the yield right now is sitting at, what was it, 7%. And let's say the cap rate for a hospital is sitting at 6%. Well, the delta is now negative 1%. So it makes it a little bit more difficult. They're going to have to focus primarily more so on debt, because as the share price, as the yield rises, the equity costs increase. So that's a way a retail investor can really think about that. So a REIT actually benefits for, it's like a self-fulfilling prophecy almost. The higher the share price, so higher share price equals better. Oh my gosh, can't type. Whatever, better. You see the other T there. Better capital price, or C price. Okay, makes sense. Pretty simple stuff. All right, so all in all, it's pretty self-explanatory with that, but yeah. So you just want to make sure that the dilution isn't crazy to the point where the FFO per share is actually declining, that they're getting accretive properties, but it makes it difficult as the share price kind of declines here. It makes it harder and harder and harder. So I think that at these levels, it's interesting. It's just not there. Let me actually plug in the rest of the growth rates that I do believe are more or less possible. So if I think 25, and yeah, you can see that we're pretty much have to assume those higher levels of growth. But again, remember, those are possible because of how a REIT gets its new real estate, and then it can actually grow the FFO per share from that delta. It will be probably a little bit harder. So that's what the market's probably pricing in, that it's a lot harder, because it used to be priced at about 20-ish bucks, and the yields at there were, you know, fairly okay. And it could have probably grown faster because it could have issued more equity at those prices, gotten a higher cap rate on the properties that it acquired. Of course, more than likely now, what's going to happen in the commercial real estate space, maybe in their sector, is that cap rates are also going to rise as demand falls, and then that's going to, you know, fix the situation. They're going to be able to, again, reacquire, depending on how their share price fares. But if their share price stays where it is right now, if cap rates begin to rise, let's say they rise to 8%, the property value of a hospital goes down, in other words, that would, you know, then bring things back into balance. They could start again issuing new shares to purchase more real estate, profit from the delta, accretive to the shareholders, etc. So one more thing I also want to say is that, well, the sentiment score is 0, but, you know, just in case you never knew about these REITs, they only have 112 employees. You can see that right there, even though it's an $8 billion company, typical for these REITs. A lot of those employees are lawyers. I asked a lot of people, if you guys work in the industry, comment down below if this is true. They commented down below. A lot of people were saying, yeah, it's full of lawyers, because there's a lot of, you know, back and forth going on with lease agreements, breaking lease agreements. So you need a lot of lawyers involved in this company. So yeah, that pretty much covers Medical Properties Trust. If you guys are enjoying the video, or if you enjoyed the video thus far, please feel free to leave a like. And as always, I'll see you guys on the next one. Bye.